One.
1, 2, 3. Yeah.
Yep.
Thanks very much. If you could take your seats. Thank you. You're all very welcome to our 10-year anniversary lecture today. As you know, our original speaker, William Goatsman, couldn't make it along, but hopefully he'll be able to come later in the year, but not as a substitute. Actually, I think as a highlight. Obviously, we've got Russell here tonight. Before I let Russell speak to you, just to say, I would like everybody to test something tonight. We have these little signs dotted round. You might see them on the way out, which are test QR codes for donation to the library. And so I'm going to ask you all to give it a test, okay? Test it out, and whatever you want to do, test whether you can give money to us tonight. And of course, bear in mind, we've got the course coming up in November. We've got the online courses, and we're open for everybody here every day of the week. So normally, as I say, Russell introduces the speaker, but since it's Russell speaking, I have the pleasure of introducing the keeper of the Library of Mistakes, Russell Napier.
Thank you, David. You forgot to mention one thing, our new product, the walking tour. So if you are so minded, you can take a financial history walking tour, which leaves from the Canongate Kirk, will walk you to Charlotte Square. It's myself and Ray Perman, who's a well-kent face around here, and we have the fantastic Susan Morrison involved in that as well. I really think it's very good, and I wouldn't normally say that. I actually think it's very good. So have a go. It's actually free, but as ever, David stuck a donation button beside it, and it's on Guidego. There's an app called Guidego. But actually, if you just put Library of Mistakes walking tour, I've discovered it comes up on the internet, and we would launch a walking tour just as it gets cold and wet. But anyway, we're launching a walking tour. So 21 lessons from financial history. We exist because we think there's some value in financial history, and some people agree. So I want to read you something from a man from Edinburgh. This is no ordinary man from Edinburgh, because he has a Nobel Prize, or at least that's what it's called that's what people call it in economics. And his name is Angus Deaton. And he has recently given a speech called Rethinking My Economics, kind of questioning some of the very basics and principles of economics as it has come to be taught, as its kind of machine. So I'm going to read you something from that speech to sort of introduce why this may be important. So this is Deaton speaking at the IMF, Rethinking My Economics, and he says, "The credibility revolution in econometrics was an understandable reaction to the identification of causal mechanisms by assertion, often controversial, sometimes incredible. But the currently approved methods, randomized control trials, differences in differences, or regression discontinuity designs, have the effect of focusing attention on local effects and away from potentially important but slow-acting mechanisms that operate with long and variable lags. Historians who understand about contingency and about multiple and multi-directional causality often do a better job than economists of identifying important mechanisms that are plausible, interesting, and worth thinking about, even if they do not meet the inferential standards of contemporary applied economics." So I think we're moving towards a stage when people will begin to look at financial history again, and that's to do with mechanisms and understanding how those mechanisms work and how they have worked and all these relationships that go well beyond the idea of the economy as a machine, because within that economy there is also psychology, politics, philosophy, sociology, and the pendulum has begun to swing to put them back in. And some of that will be in this discussion. It is called 21 Lessons from Financial History for the Way We Live Now. Many of you will recognize The Way We Live Now as a novel from the 19th century by Anthony Trollope about a great financial crisis and scandal. But these aren't necessarily the best 21 lessons from financial history. They are related to where we are now. And hopefully, well, they will be forward-looking. They'll be making lots of forward-looking assertions, which is why I know there'll be lots of disagreements when we get to the end and when we come to questions. So it's applied financial history, which means it's probably wrong. At least some of it will definitely be wrong because it's forward-looking. So number one, spend as much time analyzing supply as you spend analyzing demand. I've been in the industry since 1989. I've been in any number of meetings with professional investors, and 95% of the time is discussing demand for any given product, a demand for something. What was the demand like? Who's going to buy it? How much of it are they going to buy? How much are they going to pay for it? Because frankly, that's kind of sexy and interesting. Supply is not working out, whether it's chips or cement plants or anything, who's building new capacity, where they're building it, how competitive it is. Supply rises from the mud and demand shoots for the stars. So we spend a lot of our time focusing on demand and not supply, which is why I wanted to start with China as a lesson in history, but also something for the future. So when I was a young fund manager in Edinburgh, the Chinese stock market opened for the first time to foreign investors since the 1930s. And companies started trooping into Edinburgh to do their roadshows, brought by investment bankers. And the investment bankers pitched the demand story. And the demand story was outlandish and wrong because it was actually too conservative. It was actually too conservative. So a good example is a company called China Southern Glass, which came to Edinburgh. And the banker said, look, one day you'll go to Shanghai and there'll be lots of glass buildings. Well, there wasn't lots of glass buildings. Shanghai is all of glass buildings. So we got that, and actually we were skeptical, but we were wrong to be skeptical because it came. The share price of China Southern Glass went nowhere for a couple of decades because what we never even asked them about was supply. We didn't say, who else is building glass capacity in China? Are they building it at commercial rates? Are they looking and seeking to get commercial returns? Is this actually going to be dumping? Is this a social program rather than a commercial program? And nobody asked those questions because it just didn't seem worth asking. We all focused on the demand side. So even we were wrong, too far, too conservative on the demand side, we were very, very wrong on China and Chinese stocks because we were wrong on the supply side. Now, the index that was created when these companies were listed is not a very representative index, but it exists. It's called the MSCI China Index. Okay, I'm sure there are people in this room who know the answer to this, but 1992, where is the index today? 50% lower than it was in 1992. Now, as I said, it's not a very representative index, but even so, we've had this transformation of China, but not coming through, certainly in those stocks, those first stocks that came. There were other reasons. They weren't very good companies. They had very high valuations. But fundamentally, one of them was we didn't get the supply right. So why is this important today? Well, what happens if we wake up tomorrow morning and we're not trading with China? So that would have been an inconceivable thing to say 5 years ago. For many people, it's still an inconceivable thing. But actually, it's reality. That just one Chinese tank in the Ukraine, and we're not trading with China. The CIA say, and not everything the CIA say is true, but the CIA say that if you look at Russian munitions in the Ukraine, 80% of all the chips have come from China, either from or through China. So they don't look like tanks, but they're more effective than tanks. What is the outlook for the world if we don't trade with China? Because my entire career has been really conditioned by growing trade with China. And China's incredible impact on, frankly, oversupplying goods, depressing inflation, holding down interest rates. There's much more to the last 30 years than just China. But that's certainly been a key driver of returns from financial assets, the willingness of people to add more gearing as interest rates have come down, et cetera, et cetera. And we're about to live in a world where that doesn't happen anymore. And that would be the biggest supply shock, I think, since 1914. A bigger supply shock than 1939. A huge supply shock. What does that mean for prices? What does that mean for the stability of exchange rates? What does it mean for supply? And I think, frankly, there are lots of companies all over the world who would do exceptionally well in that scenario because they have seen their businesses destroyed by China. But they have continued, they've survived. A lot of them are in Japan or South Korea, and they're going to benefit in a world where there's less Chinese supply. So think about supply, and the reason for bringing it up at this stage in history is we may be in for a huge supply shock, which you may or may not disagree with, but the world will look, and individual businesses and profitability would look radically different if that is the supply shock we're about to have. So my job is, in my day job, obviously I spend most of my time as the keeper of the library of mistakes, but I have a day job advising financial institutions about macro matters. You might think, well, this guy is just destroyed his entire business here with this proposition. There is no relationship between GDP growth and the return from equities, and there isn't. And we run a course, as David said, and we can plot off return from equities against GDP growth, really dating back to about 1900. And there is no relationship. It just doesn't exist. And yet, how much time do people waste every day poring over these data points, poring over these growth numbers, poring over the forecast, listening to what each investment bank has to say about the economic future, when they play, at least for the long-term investor, virtually no role in determining the long-term return from equities? Now, there are many reasons for that, but a key one is a quote, and many of you will recognize it, from Warren Buffett: price is what you pay and value is what you get. And one of the reasons why this relationship is so weak is because of the valuations that equities have at any given point in time, pricing in the future. And they may already be discounting a wonderful economic future that turns up, and vice versa. So don't waste your time looking at economic growth and economic statistics if your job and your business or your welfare depends upon forecasting the stock market. Now, I've got other things I think you should look at, which would be called macro in nature, and we'll get to those. I'm going to fly through all of these. Some of them will sound like bold assertions. That's because they are. But we can go through a bit more detail because we've got 21 to get through. So Pepper, there'll be a few people in this room who remember a man called Gordon Pepper. He was the doyen of the gilt market and accidentally became an expert on the equity market as well. And Gordon was then approached by Margaret Thatcher to become one of his monetary advisors and used to teach on the course. And he was standing up one day, much as I'm doing now, and someone said to him, "Well, Mr. Pepper, you've been in the market since 1961, which he has. How do I know when a market is peaked?" And this is what he came up with. Now, I think it's the best one I've seen yet, and it's completely subjective, because I don't think there is an objective way to say when a market's overvalued. I have written a book about how to work out when it's undervalued, which will be right or wrong. Has been right once already. But this is what Gordon said: estimate how long the unsustainable can be sustained, double it, and take off a month. Now, I mean, if you're not in the markets, you will not find that as funny as probably the rest of us do. But there is a certain logic in this, that these things, the unsustainable, will remain unsustainable for much longer than you think. Use your brain, your rationale. However long you think it's going to last, it's invariably going to last that bit longer. So think of Pepper's Law. If you really want to leave the party at midnight, which is something I do not recommend, but if you really want to try and leave the party at midnight, Pepper's Law may be the better guess as to how you leave, the best way of working out when you might leave the party at midnight. I can't think of another one, but maybe somebody else will offer one after in the Q&A. So you could have 21 lessons from financial history just quoting Charlie Munger. And Munger, of course, was a voracious reader. Never, ever think about anything else when you should be thinking about incentives. Now, that seems to be so obvious, but I've spent my early part of my life reading lots of investment reports on companies, and nobody ever told me what the incentives were of the management. Sometimes it said stock options, but actually there's much more going on in a corporation than stock options, and it seems to be really peculiar to be offered an investment where you don't know the incentives of the management, or at least there's not 4 pages written about. The incentives of a family-run company are probably radically different from one run by agents. Agents and principals have different incentives. We need to think about that when we make an investment. Now, the reason I've actually put it up there has nothing to do with companies. The reason I think this is important today is the incentives for one man in this world will determine the rest of the 21st century, and that is Xi Jinping. Xi Jinping has got some huge decisions to make, not just about the growth of the Chinese economy, how confrontational, further confrontational he wants to be with the West, will the currency float, and it's the nature of China that those will be made by one man. And what are that one man's incentives? Well, I wish I knew. I mean, lots of people spend their lives trying to work out the incentives that Xi Jinping has, and we're just going to have to try and work that out. But I think more than really at any other time, certainly more in my lifetime, this is the first time that the decisions and the incentives of one individual will play a role. Now, my view is he will have to reflate his economy, and he will have to do whatever is necessary to reflate his economy, even though he doesn't have to get elected. And that's kind of the big question. People say he doesn't have to get elected. He's got very different incentives from someone trying to get elected, so he doesn't really care that much about the economy. What he does care about social stability, and therefore will have to move to reflate economy. And that takes me to the next big assertion. This isn't possible with a stable exchange rate. It's just not going to be possible. It is nuts that the world's second biggest economy pegs its currency to somebody else. I mean, if New Zealand can have an independent monetary policy with a flexible exchange rate, why can't China? If Xi wants to rule his country, he needs to control the mechanism which sets the price and the quantity of money. And currently he has a restriction or a fetter on that. So I put this up to say that if we look to the future of China, it's a country that is going to have an independent exchange rate. It's not going to have an exchange rate policy. And what does a flexible exchange rate mean for all of us if the Chinese exchange rate goes down or possibly even up? And what does that mean for how the global monetary system works? And I'm raising them as questions because the answers take about an hour and a half to go through of all that. But really, since '94, the link between the dollar and the US dollar and the renminbi has been the cornerstone of the global monetary system. It has been the determinant, the key determinant, if not the sole determinant, of monetary policy, the level of interest rates, the level of inflation. Many people in this room are just about old enough to remember the Bretton Woods Agreement. You say, well, what's the agreement today called? And there's no name for it, but it exists. And it's been based around this relationship. And this relationship is highly likely to structurally change now if Xi really has to reflate his economy and get out of the deflationary mess that it's currently in. There is certainly if you read most textbooks in economics, there's this kind of myth that the government is a referee and there are two sides playing against each other on this pitch and the government referees. And those two sides are supply and demand. And the government referees this based upon some laws and rules, and the laws of supply and demand determine price. Well, there's virtually nothing in economic history that says that's true, simply because the governments very rarely like the prices. So if we go into that sort of Thatcher-Reagan post-Thatcher-Reagan era, the markets delivered what politicians wanted. So they could give the illusion that they were referees. We're not in this playing field. We're just standing aside. But that's because the markets delivered what they wanted. And now the markets have delivered something that they didn't want. Many things that they didn't want. First amongst equals is an excessively high level of debt, not just in the government, but in the private sector. And now we're looking at a world where, if you pick up my textbook, it tells me the government's a referee. If I switch on the television, it's quite clear the government isn't a referee. It's intervening. So if you want to understand how that works, the best way to do that is read financial history, because you won't find it in the economic textbooks. What are the proclivities of government to intervene? How would they intervene? Where would they intervene? What prices are they most likely not to like? Well, that's a question of politics and sociology, philosophy and psychology, not one that is in the textbooks that's focused more on decimal points, numbers, and supply and demand. So we've reached a stage in history, I think very clearly, where we have to work out what is the new relationship between the government and the markets. And the idea that it's static and is not going to change, and that everything that happened in the last 30 years, or let's say from '79 until 2007, that's the rule book upon which we can all play, is an exceptionally dangerous thing to do. So a reader of financial history is looking at different relationships. Personally, I want to look at the relationship between the state and the financial system from 1945 to '79. I think there'll be lots of similarities and work from there. I listened to Rachel Reeves' speech yesterday. I think she used the word build 25 times. Where's she going to get the money to build from? Well, the answer is you, one way or another. And that's what we did after World War II. Our debt to GDP ratio came down. We nationalised a lot of industries. We built the National Health Service and lots of them. How did we do all that? By manipulating the savings of the people. That's one of the ways in which it could be done. So once again, each one of these points, by the way, has a kind of a 1 hour to 90-minute full discussion. But you cannot be turning kids out of university believing that this is true, because the whole of financial history proves that it isn't true. The governments will not stand by and let supply and demand determine price. They might do it for 10 years, they might do it for 15 years, but ultimately if they don't like the prices, they change it. The ratio of corporate profits to GDP must mean revert in a free society. Now, there is a thing, I'm not a mathematician, but there's a thing called the Otte-Dickey-Fuller test for mean reversion. And the most mean reverting series we can find in economic history is US corporate profits to GDP, which is quite a thing, because if you can find something that mean reverts, you can probably make some money out of it. And we can't find that many that mean revert, but corporate profits to GDP in America do mean revert, or have mean reverted. I should use the past tense. The data starts in 1926. It may not necessarily be true in the future. Why is that so? Why in a free society would corporate profits mean revert? Well, to be slightly Marxist about this, there are competing interest groups in any society, whether it's labour, capital, creditors, the taxman, and they fight over the allocation of wealth. And to assume that one has permanently won, well, that can be true in a dictatorship. I mean, corporatism would be a pretty good example of that. But it's difficult to see how it could be true in a democracy. There should be a swing in the balance of wealth. And for many years, of course, it's been very much to the benefit of corporations, not to the benefit of labour or the taxman or the creditor. But going forward, maybe they'll do better. Or their pensioners. Maybe they'll do better than the corporations. So it has been reverted. It will be a decent guide to this. And I think if you're looking at any stock market that you want to invest in anywhere in the world, you want to see where corporate profits are relative to GDP. You want to check that you're not at a very high level as a warning signal that this may not be the best time. And if they're at a very low level, as they almost certainly were in the late 1970s, in the United Kingdom, this may be a time to look. So these are macro factors that you should be looking at, but they're not associated with, hey, GDP is going to be 2.5% next year and inflation is going to be 3%. These are different, more structural in nature, as Angus Deaton said, more to do with mechanisms than to do with forecasting the next 6 or 12 months. Monetary policy is not about interest rates. Now, we have a fixation, the press, not just the press, the central bankers themselves have a fixation that interest rates are monetary policy. And interest rates are like the accelerator in a car. The monetary policy is the supply of money. Now, not everybody is going to agree with that, but the central bankers are fixated on this pedal that they push up and down. And really, it seems sometimes disinterested in the quantity of money in the economy. Now, we've paid a price for that in recent years. From the end of 2019 to the middle of 2022, 40% of all the dollars ever created in history were created in that one period. And guess what happened next? We had lots of inflation. And the central bankers said they didn't know why. They didn't understand why we had that inflation. Now, by the way, we have no growth in the money supply, virtually none, which is going to be a different problem when the time comes. We've begun to eat through those monetary balances that were created, and the money creation process is really not working. Now, why is it important today? Well, it's because commercial banks make money. I say that all the time. Nobody believes me, but fortunately, the Bank of England have just written a little article on it, stuck it on their website, so now people believe me. According to the Bank of England, 80% of all the sterling ever made in history has been made by the commercial banks, not by the government, not by the central bank. In other words, whoever controls the banks is the monetary authority. Now, in that period I mentioned, 45 to 79, the banks were almost certainly directly controlled by the government. We didn't spend a lot of time moving interest rates up and down. That was not the mechanism through which the growth in bank balance sheets and money was controlled. We used a thing called the Bank of England Governor's Eyebrow. So the Bank of Governor would declare, he would bring the big clearers in, he'd say, this year, guys, you're growing your balance sheets at 10%. See you at Christmas. Now, if at October you'd got to 10%, he called you in and he raised his eyebrow. And that's it. That's called the quantitative control of bank credit. And what does it deliver to a government? Well, what it delivers to a government is credit going where they probably wanted to go. I mean, they had a role to play in who was getting that credit. This was called, you might remember this was called 363 banking, right? no, 3. So borrow at 3, lend at 6 on the golf course for 3. And the reason that banking existed is because there was only an allotted amount of credit you had to allocate during the year anyway, and there was nothing to do after 3 o'clock because you'd probably allocated that day's allocation. The temptation for governments to get back into the banking system will be overwhelming because it will allow them to steer credit to all these investments they need, build, but also to have a more direct control over the quantity of money. If central bankers are in disrepute because they created too much, and in my opinion now create too little, the governments will say, well, look, interest rates are clearly not the best tool for this thing at all. What we need is the governments determining the growth rate in bank credit. So we'll see much more. The reason for bringing it up now is if monetary policy is the quantity of money, a central banker doesn't run monetary policy if the government runs the bank. So I think a nice analogy I try to use is of a coachman or a coachwoman with 6 horses. That's the central banker. The 6 horses are the commercial banks. The central banker has reins running to the horses, interest rates, liquidity ratios, capital ratios, risk weighting of assets. And through these mechanisms, which are the reins, it tries to steer these banks in the right directions to create the right amount of money required for its inflation target. What happens if it wakes up and the 6 horses have 6 jockeys? Then it's kind of irrelevant. And that, I think, is what we're moving into. This is how governments are going to fund what they need to fund. Remember, their own balance sheets are somewhat limited. That's a kind of euphemism. The British government just hit 100% of GDP. There are many of our European neighbours who've got much higher levels than 100% of GDP. So this is why it's important now. This one is famous from Walter Bagehot. John Bull can stand many things, but he cannot stand 2%. In other words, when interest rates begin to decline and you have got your savings, so to have savings you have to work hard, pay tax, forego consumption. This is frozen desire. Now, most people aren't very good at frozen desire unless they're Presbyterians. So this is your frozen desire, and then having made all those sacrifices, you believe that you deserve a return from that. And throughout history, there's a number that comes up. For that, it's 5% or more. Throughout history, whether it's the novels of Jane Austen or anything else, you find someone, I want 5%, I deserve 5%. And as rates come down below 5%, towards the 2%, perfectly reasonable people do remarkably stupid things in pursuit of their 5%. So a few years ago, I spoke over in Ayrshire on a different subject, and I mentioned this. And a man came up to me afterwards, and he'd clearly been in an industrial concern of some sort with a defined benefit pension. And as you know, you could get quite big payouts on that. And he came up to me and said, look, I just wanted to ask you something. He said, all my friends, they got all this lump sum, and they've all bought into Portuguese vineyards. And I noticed that the guaranteed yield was 5%. Do you think it's wise to be buying Portuguese vineyards yielding 5%? I said, well, would you? Why on earth would you do that? It's because they all thought, I've got this money, more money than I could ever have dreamed of. I deserve 5%. And they just simply sat there until someone appeared and offered them the 5%. So we actually just been through a period of the lowest level of interest rates in the 5,000-year history of interest rates. We've just had it. I think all of us thought there was massive speculation going on somewhere. Interestingly, we haven't had a lot of collapses yet in terms of what's been going on. But somebody out there, the tide is going out. Debt service ratios are still rising, even if interest rates are coming down. And we will find out who was speculating. Now, there's usual suspects in this. Actually, German banks are one of the normal suspects on this because they get such low yields at home. They're usually involved in some sort of speculation somewhere else. But I guess one of the surprises is so far, Bagehot is not proving right on this occasion, which suggests that it's been delayed. Somebody somewhere took the 5% and has taken an undue amount of risk. So when interest rates are low, consider to yourself whether this is really a wise investment. If I look at the United Kingdom by 1890, investment trusts, for instance, which had started maybe owning some government debt, usually ended up owning Egyptian government debt by the 1890s because the yield on British government securities had come down to Bagehot's magic 2%. Well, I could talk for about a year on that. The rule of law and property rights are ultimately what defend you as an investor, and if you don't have those, you don't have anything. And I think we forget it all the time. So I trained as a lawyer, so I've maybe got too much of a respect for this, but people are investing money all over the world in places where it really isn't clear whether they have any protection. Can you sue the government? Could I, as an investor in China, take an action against the Chinese Communist Party and hope to win? Well, these are questions you have to ask. You might have a different answer from me, but they're questions that you have to ask, and we don't ask them. If it has a stock market, you think, oh, it's got a stock market, let's move on to the next question. But I found this out very dramatically in 1998 in Thailand. The old Thai economy collapsed. A lot of that equity was wiped out. People had some debt, they had some equity, and they would phone up the stockbroking company I was working for and say, can you run us through the Thai bankruptcy laws? Nobody knew what the Thai bankruptcy laws were. Nobody. And nobody knew that they were radically different from British bankruptcy laws, because no one ever asked that question. How do I defend my property rights in a court of law? Was never asked. So in my lifetime, there's been a massive expansion in the number of stock markets in the world, but this is not the same thing as saying that everything has the same property rights. So the great Scottish investment trust that invested in America didn't tend to invest money in Dodge City. Dodge City was run by men with guns, and if you didn't have a man with a gun to defend your property rights, you didn't have any property rights. But we seem to have forgotten this, and you can probably tell from all of that. I'm a bit skeptical as to what the true property rights are for an investor in China. So ask this question first. Don't ask it when things have gone wrong. Because if these things don't hold up, then everything else is irrelevant. Don't worry, it's only a business cycle, it'll all come good in the end, isn't actually true for many countries where they've closed the stock market or expropriated property, either in aggregate or selected assets. This is probably more important than ever. We've seen if we had lots of Russian investors here, they would be sort of maybe nodding their head at this stage. The companies most likely to default on their debt are those who have defaulted on their debt. And we have a wonderful book in here called This Time It's Different by Reinhardt and Rogoff, and they list the serial defaulters, and they keep coming up again and again. Why? Well, I think it's because of the institutions. Most of the people who default actually borrow in foreign currency. If you think of the great defaulters, whether it's Argentina, actually Egypt is another one, and they borrow in a foreign currency. And then when you have to pay it back, you've really got a very simple choice. Do I force my people into low levels of consumption, economic contraction, run a huge current account surplus, so I earn all this foreign currency and pay it back, or do I not pay back the foreigners? And they weigh that up for an hour and a half, and they come to the conclusion that I'm not getting elected if I force my people into that adjustment, and they default. And it's the same people. I think there are 9 of them on the Reinhardt and Rogoff list, but it's kind of taking us back to the last point. These institutions count. Do you have institutions that hold up against that kind of populism, or do they crumble? And if we look at those 9 countries, they have institutions which historically have crumbled and have not been able to say, well, look, if we don't defend the property rights of foreign investors, here are the consequences. Now, this one is really my last lecture in the course, which I know you're all signing up for, so I'll leave that till later. But anyway, the point is it takes about 2 hours to go through all of this. But if I ask anybody, if I stop anybody in the street and say, what about stock markets? How do they come down? And they'll use the word crash. They crash. If you say the word stock market and ask someone to put a word behind it, the word they will probably choose is crash. By the way, the code to get into the internet here is the stock market crash of 1929. That isn't the only way you can lose money in equities. There are other ways you can lose money in equities, which are much more insipid, but just as painful. So if we look at the sort of measurement of the valuation of equities, and we have one that goes back to 1881, there's a period from 1901 to 1921 where you didn't lose money in a crash, you lost money slowly. And there's obviously that period from 1966 to 1982, which, there was a crash in there, but actually we're losing money through that entire 16-year period. And the point about that is that when what faces you is collapse and deflation, which is what we faced in 2009, then share prices can come down really quickly. Remember what a share is. A share is the balance, is the bit that's left between assets and liabilities. I call it the thin sliver of hope between assets and liabilities. And if your cash flows are falling and your asset prices are going down, the thin sliver can disappear. So in a deflation, suddenly you think, hey, there's nothing left. I think a good example is General Electric. It's been in that index in America since, I think it's 1896 in the Dow Jones, ever since there's been a Dow Jones anyway. In the first quarter of 2009, it didn't exist. It had to go and get its paper, its commercial paper, guaranteed by the American government because it was about to disappear. Ask any investor what they did when they worked out the net present value of General Electric. They said, well, we discount the cash flows back to calculate the net present value. And I said, what period do you use? Well, for General Electric, you would have used infinity because it had been around for 100 years. And then one afternoon, the correct discounting period was a week and a half, had it not had its paper guaranteed by the government. But inflation can bring equity valuations down slowly. And those two periods I mentioned, 1901 to 21, 66 to 82, the surprises were inflation. And interest rates had to go up to levels that people didn't think. The valuation of equities had to come down. Throughout this period, the companies were earning more money. They weren't earning less money. It wasn't like 2007 to 2009. Corporate profits were going up, but the valuation of stocks was coming down. So when you think of a stock market and when it's seemingly overvalued, remember that there's other ways to lose money than just a crash. And that takes us back to the issue of valuation. Both of those periods, 1901, 1966, equities were very expensive, but US equities not as expensive as they are today. So you don't have to foresee a crash, a dramatic event, to say that it's dangerous to invest, and I should stress this, in the equity index. Not necessarily in equities generally, but in the equity index. Had you bought value stocks, mid-cap value stocks in 1966, you actually made a positive real return on the holding period where everybody else who was in the S&P was losing money. So as I say, there's a good 90 minutes to 2 hours on that. Never buy emerging market equities if the exchange rate is overvalued. So this is something you kind of learn the hard way when you're in an emerging market. Let me give you my experience of the range of valuations for emerging market equities. Taiwan, 1989, 64 times earnings. Hong Kong, 1998, 9 times earnings. It's quite a big range. In fact, it's a hell of a big range. Not the sort of range you expect in other stock markets. But that's because those countries run managed exchange rate regimes. They intervene in the exchange rate. And sometimes, if the exchange rate is grossly overvalued, then at some stage they're going to have to run a tight monetary policy to defend that exchange rate. Not based upon the economic conditions of the country, but simply based upon the exchange rate. Now, many people in this room know this because we were around in 1992 when Norman Lamont decided to defend our exchange rate and, briefly, for an afternoon, got nominal interest rates to a level that would have destroyed the British economy. No chancellor not trying to target the exchange rate would ever have taken nominal rates, no matter how briefly, to that level. So when these emerging markets use this, that actually, when you're looking at equities, and whether they're good value or bad value, it is imperative that you look at this exchange rate to try and determine whether it's overvalued or undervalued. If it's undervalued, then the central bank will be intervening to try and stop the currency going up, and part of that intervention is to create much more money in the economy. In other words, the disequilibrium here is going to be much, much bigger than it would be where I can move my interest rate entirely independently based upon my view of where inflation will be. So you get these great imbalances, which are very profitable on both sides if that exchange rate policy is in place. But why do I put it up? Because people very rarely look at it. They look at the PE of the market, they look at ways of valuing the equity market, but they don't ask themselves, is this exchange rate overvalued or undervalued? One slightly tongue-in-cheek, but when you want to work out the value of anything, stick with the principles and ignore the agents. Now, agents, managerial capitalism has taken over the system, and the incentives of agents are very different. So when I want to work out what an expensive exchange rate is, and I go to the Rockefeller Center at Christmas, and I stand beside the Christmas tree, and I listen to what languages are being spoken, and then I short the hell out of the currency. So you can tell that that's a slightly facetious comment. But to be around the Rockefeller Center at Christmas, you're paying $700 to $800 a night to be in a hotel room. And actually, it's not that bad. By the way, if you go there, and I haven't been for a few years, but last time I went, it was French and Italian, so I'll let you come to your own conclusion on that, and Irish. The important point is real people with their own money know better than economists, and they know better than agents. So the easy one in an emerging market is get off the airplane, go to the baggage reclaim. If you start seeing toasters and rice cookers and televisions coming down, guess what? The exchange rate's overvalued. Because those people have found it more profitable to go over somewhere else and buy these very basic commodities and bring them back. There's a ship that leaves from China to Japan and back every day. People take little rooms and they come back full of consumer goods. Much cheaper to buy your consumer goods in Japan than China, and yet one of them is an emerging market. What does that say potentially about the Chinese exchange rate? For the people who have to make basic decisions, the best people to make decisions about value are poor people, not rich people. So I discovered this in Malaysia. So I go to Malaysia in 95, 96. For those of you who don't know, the whole Malaysian economy collapses in 96, 97, 98. And what I see is foreigners queuing up to buy the listed equities of Malaysia, and Malaysians queuing up to buy every foreign asset they can get their hand on. Now, if you put a point to a foreign institutional investor that, you know, all these Malaysian companies that you're investing in are actually buying all these overseas assets, they would reply, well, they're stupid. But in this game, it was the principals, or people more aligned with the principals, and not the agents who were right. So don't spend all your time listening to agents. Try and find a principal in any economy and get the opinion of a principal. 14, this is the CAPE ratio, the famous Shiller ratio. It's called the cyclically adjusted PE. If you don't know what that is, you'll find lots about it online. Historically, almost always, if it gets to a level below 10 times earnings, then you buy equities. Because historically, when equities are that cheap, they're discounting such a dire outcome that somebody does something about it. Now, we didn't get there. We didn't quite get there in 2009. But the outcome that they were predicting was so dire that the central bank ripped up the rule book, for instance, and it did quantitative easing. In Hong Kong in 98, it was so dire that the central bank, or the monetary authority, started buying equities. In 2011, once again, same valuation. Mario Draghi says whatever it takes. He completely ignores the constitution of the central bank. In 1932, it happens again. America leaves the gold standard. It can't cope with the consequences that flow from the economic mess that this is discounting. So to the extent that a country is free to do so, it will do anything to reflate its economy rather than accept the dreadful deflationary outcomes that are being priced in, so you should buy the equities. Now, as with all rules from financial history, there are exceptions, and I've put them up here. Let's say that I was standing here in early 2008 saying, you've got to buy the Greek stock market, it's on 10 times cyclically adjusted PE. Well, you lost a huge amount of money because the Greeks couldn't do anything about the coming destruction. They didn't have an independent central bank. They were part of the Eurozone. They couldn't do quantitative easing. They couldn't cut interest rates. They couldn't float the exchange rate. All the normal things that a government in distress, whether you like it or not, would do, they couldn't do. So equity prices went down lower. So you need to keep an eye on the monetary independence. If there's no monetary independence, equities can get very cheap. And then, of course, you have war or the surrender or communism. These are ways that you can lose all of your investments. We don't think about them because we don't want to think about them. But historically, some of the greatest losses of wealth in history have come from war, communism, or locking yourself into the wrong monetary policy. This one's controversial because it's to do with capital controls, and I've lived certainly my entire investment career in a world without capital controls, but I have worked in emerging markets that do have capital controls. They are now seen as something that was just a mad part of history, but I think they're normal. Now, if you say, well, we haven't seen them in the developed world for 30-odd years, 40-odd years, well, that's a short blink for a financial historian. The lifting of the exchange controls allowed capital to arbitrage labour, to arbitrage governments, and perhaps one of the reasons why corporate profits to GDP have gone up so much is capital has that arbitrage. Governments can't leave, labour on the whole can't leave. So it made it exceptionally powerful. And if you're looking at a world where you say, well, actually over time, corporate profits to GDP are likely to mean revert, one of the ways would be for the governments to get more control over capital. Now, it may be full-blown capital controls. It can be something less than capital controls. But I equate it with democracy, and this is why it's quite controversial. We've really only been a democracy since 1928, because that's when women without property get to vote. Really, for quite a lot of the time since then, we've actually had capital controls. Now, not since 79, but for most of the period between that, we had capital controls. because a democracy seeks to get this balance. Whether you like it or not, it seeks to intervene to get the balance. And ultimately, it may be exceptionally difficult to get the balance between capital, labour, or government to get that without the assistance of capital controls. So I think we'll see them again. I think they'll be back. And for those who say, well, developed world countries will never have capital controls, I can cite Greece, Cyprus, and Iceland, who've all had them within the last 12 years. Now, they had them and lifted them, but they did have to resort to these, the debt burden upon the government being so high. Usually the debt burden of the private sector cascading into the government. The only way they could cope with it was capital controls. So we can't rule out that they're coming back. I think it's likely that they come back in some form, and there are sort of lesser forms than the ones we used to have. And if you want to know what capital controls are all about, you should read Travels with My Aunt by Graham Greene, which is an excellent read, but also really about capital controls. And if I say any more, it'll ruin the entire story. So, number 16. Yeah, so I don't think we're going to have hyperinflation because we haven't stolen everybody's savings yet. So when you look at countries that go to hyperinflation, they print money, hand it to the government, and the government spends it. Lots of circulation of money goes up. Not surprisingly, prices go up. That's hyperinflation. These are countries that weren't in a situation where they could seize, cajole, or control the savings of their people. So Germany after World War I doesn't really have any savings because the people of Germany have already bought government bonds that have gone to zero to finance World War I. By the time Zimbabwe gets to its hyperinflation, well, there's really no savings left in Zimbabwe because they've already been destroyed. But as long as you as a government can access the savings of the people, you don't need to go to the printing press. Now, you can access the savings of the people in two ways. You can persuade them, or you can force them. And before you get to hyperinflation, you get to forcing them, forcing it. Now, the obvious example is war bond drives. We have a couple of posters in here for World War I war bonds. So when people look at the excessive levels of debt we have in the economy and say only hyperinflation will sort this out, well, there is another way, which is to force you to fund the government at really low interest rates and have inflation slightly above it, but not at the level of inflation. So I think it's highly unlikely that any developed world country would choose the hyperinflation route because there's another way of doing it. Now, that's pretty bad if you're a saver, but for most governments, they will consider that to be the lesser evil than going to the hyperinflation, which historically has destroyed the middle class, or the property-owning classes, and led to social upheaval. Technology never ultimately defeats inflation. I used to, because I've been doing this a long time with investment managers, it's not that long ago that when I would talk about the forthcoming inflation, that people would say to me, well, we can't have it because Jeff Bezos won't allow it. Jeff has got this great big Amazon machine and is always selling things cheaper, and Jeff sources things from all over the world. And therefore, because of this technological revolution, prices can't go up. And then, as I mentioned earlier, we increased the money supply by 40%, and guess what? Even Jeff couldn't stop the rise in prices. So I was doing this at the University of Oxford one day. A professor of physics put his hand up and showed me his digital watch and said, I paid $850 for one of these in 1971, and now you can get them free in a packet of cornflakes. How can you tell me that technology doesn't beat inflation? Well, I showed him, or I made up, really, from memory, but I think fairly accurately, what had happened to the general price level of the United Kingdom since 1971. From memory, 10 times. So yeah, technology came, it increased production of these watches, it brought down the price of these watches. But if you try to work out why prices went up so much as we had this technological revolution, well, it kind of kept up with the pace in the growth of money. And over the last 124 years, think of the incredible technological breakthroughs we've had. And yet, prices, as measured in money, which is the way we measure them, are up hugely since then. So the argument that technology will prevent inflation, I think, is not as well versed as it used to be. But I think it's wrong. Monetary systems fail about every 30 years. 30 years is a very sort of made-up number. But I think the last time we set up a new monetary system was 1994 with the devaluation of the renminbi and linking it to the dollar. That established a new monetary system. Prior to that, it had collapsed in 71 with the Bretton Woods Agreement. And we had lots of tinkering in the middle there with the snake and the Smithsonian. Prior to the Bretton Woods Agreement, it had been the end of the gold standard. Prior to that had been the previous end of the gold standard for most people in 1914. It's important because most of the people who invest money look for the business cycle. and they try to judge the business cycle and try to judge when's a good time to invest. And then suddenly there's a structural change, a massive structural change. And to make money and to preserve your wealth, it's understanding that structural change, which is important. So let's say we're sitting here in 1969, and we're looking, there's one half of the room is looking at the next 3 years economic cycle and whether to buy equities, and everybody in this side of the room thinks the Bretton Woods system is going to blow apart. Well, this was the right question to ask, because the assets you wanted to own and invest in were ones that would benefit in some way, and certainly avoid lots of losers by the end of that structural system. And we're due another one. And I've put it to you what I think it is, which is the end of the link between the United States dollar and the Chinese currency. But I think all of us inherently feel that we're living through a period of structural change. And if I asked you to list 5 of them, you'd give me 5, and 5 good ones. But it probably wouldn't be the end of the international monetary system, because it doesn't have a name. How can something end that doesn't have a name? Paul Volcker, by the way, used to call this the non-system. But it's still a system. It wasn't agreed in a room. It wasn't agreed by all the parties. But it's a system which is coming apart. And I would argue that understanding the implications of that, well, financial history is really very good at that. Because if you're not going to get it from financial history, where are you going to get it from? And what's that new system going to look like? Well, I can talk about that for a long time, but I suspect capital controls would be part of that new system. I think I've covered it. Money is almost always in disequilibrium. The world's full of equilibrium models, and certainly in markets, which is my business, not economics. I think we reach equilibrium once every 30 to 40 years. Sadly, your career is dealing in slightly shorter time periods than that equilibrium. But if you ask me why we get into disequilibrium, I would credit it to, I should really have it here, money and credit. And it's money and credit that generates the disequilibriums that we oscillate around. And don't ever work off an equilibrium. If you're working off an equilibrium model in markets, then you're just probably going to go home and say it's too difficult. If you can conceive of a disequilibrium, if you could point to one, and I think managed exchange rates produce more than flexible exchange rates, then there is an opportunity. But always look around the world for that disequilibrium. And if you read Soros's The Alchemy of Finance, it's effectively about disequilibriums and how to make money out of them on the long side and the short side. So this is not necessarily in the textbooks, but look for this disequilibrium. Never trust a forecast with a decimal point. So I have been forecasting for 30 years now, and I've never used a decimal point. I'm not saying that's a good thing or a bad thing, but I've never used one because I think I'd be fooling my clients. I think I'd be fooling my clients to walk into a room and say, well, I have this forecast for next year for 2.5 or 3.2. And the reason I'd be fooling them is I would be pretending to have a level of precision and knowledge which I frankly don't have. So often, and it happened to be today, actually, last night I was talking to someone, he said, about the future. He said, but all you've given me is a story about the future. I said, well, would you prefer a decimal point? Because I can get one. I could certainly go and gather one up somewhere and stick it, because that's what he wanted. He wanted the precision of an economist who would say, and here is the decimal point. In my experience, forecasting markets anyway, maybe not so much economics, is it's difficult enough to get the direction right, never mind the quantum right, and then put in a decimal point. And sometimes people put in 2 numbers to the right of the decimal point, which is pretty shocking. Now, there are two reasons why they might do this. Number one, they've been brought up to do it. They've been to university, studied economics. That's what you do. That's what a paid economist does. Or more dangerously, they're trying to mislead you, because they're trying to tell you that you should be confident in them, because they do have the knowledge to be that precise. And that's sales. It's not analysis, it's sales, and it works. That degree of confidence works. Human beings hate uncertainty, and they will pay a fortune to avoid it, as everybody in this room knows, because you're all paying insurance premiums, probably that you don't really have to pay, but you're paying them anyway. And if I walk into a room with the certainty of the decimal point, then I can sell things to you. And of course, the next bit is never trust your own forecast with a decimal point, because there's nothing more dangerous than overconfidence. The only thing more dangerous than overconfidence in somebody else is overconfidence in yourself. Now you're fooling yourself. So we have to get away. One of the lessons of financial history, I think, is that the decimal point is not a useful tool. It's a deceptive tool. Now I'm going to end on number 21 with a misquote from Karl Marx, because you can't talk about financial history without talking about Karl Marx. Oh, away it went. There it is. Marx famously said that religion is the opiate of the people. Well, I think he's wrong on that, but this is what the opiate of the people is. Extrapolation is the opiate of the people. So in 1995, when I went to Hong Kong, I printed out this huge thing. It said, no extrapolation allowed. And I sat here, and it was on the board behind me, right over my head. There was this great big thing said, no extrapolation allowed. Everybody who sat on the table opposite me extrapolated. And I extrapolated, of course we do, because that's the easy way to make a forecast, to extrapolate. Now, there's somebody in the investment trust world, I don't think he's here tonight, he said to me, he said, this was bad enough, but as soon as we invented the Excel spreadsheet, it just got completely out of control. And I think that's true, because it became so much easier to extrapolate. So straight line extrapolation, in my opinion, is the opiate of the people. And that leaves this messy world, a world without decimal points, a world where it's really, really difficult to make forecasts. And that's the real world. And it's a world which we have a much better chance of understanding if we have an in-depth knowledge of financial history, a range of outcomes that you know are possible, and you'll have to wait whether they're probable or not. And that's a different approach to economics and investment than is common. I'm not saying people don't do it, some people do it, but not everybody does it. So I just want to finish, because I'm sure I've run way over, on a quote from the Duke of Wellington, who was asked about warfare. And he said, all the business of warfare, and indeed all the business of life, is knowing what's on the other side of the hill. So if you study financial history, you've got a better idea of what's on the other side of the hill. You've got a better idea of what's going to happen. You have a better idea of how you should react to it, but you still don't know what's on the other side of the hill. So I can't give you that decimal point, but I can give you a reason why you should be reading more financial history. Thank you. David, you're going to pick people, are you? Oh, go ahead. Yep.
Well, who wants to ask a question of Russell?
Oh, great. Thanks, Russell. My period in investment markets has been the last 3 or 4 decades, but it seems to me we've had eras where bonds have dominated, particularly government bonds. In the my era, equities have definitely dominated. Does it go in swings like that in your view, and therefore maybe one ought to pay more attention to gilts, or maybe it's a more balanced world? Because either could do well.
Yeah, so there is there is something financial history can say about that, because we have data on the returns from government bonds over a very long period of time. By the way, they did exceptionally well. Probably the best returns they've ever posted. In the course, we have a rolling 30-year return from bonds, cash, and equities starting in 1831. Bonds did spectacularly well all the way until 2020. But what I can tell you about bonds, and this is mainly from a book in here called The History of Interest Rates by Homer and Silla, is that when they're in bull or bear markets, they tend to last 30 years. And our bear market started in 2020, maybe 2021. Equity bear markets can be very quick. I mean, equities were very expensive in 29 and very cheap in 32. How do we know that? Because if you bought them in 29, you had 15 years of really bad returns. If you bought them in 32, you had 15 years and longer of spectacularly good returns. So what you can say is that equities can very rapidly become cheap, but there's no evidence that bonds can do that. It takes a very, very long time indeed, and we can get the data. I think there's a bond from Genoa going back to 1100. But anyway, the data I'm looking at is British data, so it'll be a 30-year bear market for bonds. But it is worth remembering that bond bear markets don't have to happen in nominal terms. So that doesn't mean to say that we come back in 10 years and yields are 15%, because it could just be inflation. The yield could be roughly where it is today, but you would have had more inflation. So I think what a financial historian would say about that is that US equities are very overvalued. Bonds have entered a 30-year bear market, so you better look somewhere else. And I think when you look somewhere else, there are lots of equity markets, or equities, maybe not so much markets, that are pretty cheap. And that would be a much better place to invest in bonds if we are in the beginning of what would be a 30-year bear market, which is just us inflating away our debts. So if I say to you, we're going to inflate away our debts, and most people in this room are nodding, why the hell would you want to own bonds? The whole point of inflating away debts is to destroy the purchasing power of bonds. Is that Martin who's got the question? Yeah. This will be a nice, easy one, Martin.
Thank you, Russell. You know, as somebody with, I guess, a few decades of experience myself, I could agree with most of your lessons. I can certainly identify with them. But you'd be disappointed if I didn't challenge you on a couple of them.
Okay.
So, and two of them are very dear to my own heart because I've done a lot of work on them. Lessons 6 and 7.
Yeah.
The mean reversion of profits.
Yeah.
Yeah, historically, it was literally one of the most shares of income, labor share, profit share going to profits were the most mean reverting shares you could find.
Yeah.
In the year about 2000, in the US, that's what I've looked at, completely changed. Standard deviations away from the mean for all kinds of reasons, globalization, blah, blah, blah. And it has not mean reverted over 2 decades. And the question is, if it were to mean revert to its old mean, you'd be talking about a catastrophic collapse of the stock market because earnings would melt beyond anything we've seen. So the question is, revert to what mean? Because you do get structural shifts, and you cannot use a historical mean for the profit share of GDP relative to the current. We are just so far above it. Something has shifted, and we are not in a free market. In a total free market, it should mean revert. New companies come in to capture the high profits, but we're more oligopolistic now.
We are. There's a thing called the Herfindahl.
One more. I've got to challenge number 7.
Well, let me do them one at a time because I'll forget them. So the first one is we have the Herfindahl index, which proves that. We've been here 1901. I mentioned 1901, a time when equities were grossly overvalued. One of the reasons that after that maybe they didn't do so well is we had Teddy Roosevelt busting up trusts. I mean, these things, this is trust busting. These things are insurmountable. They'll last forever. Well, a democracy decided that they wouldn't and did something about it. Now, it turns out that some stocks did okay from that, some didn't. It is true. I mean, if I draw you a chart of this, basically after 1995, we seem to go into a permanently higher plateau for corporate profits and a permanently higher plateau for equity valuations. And it oscillates on the permanently higher plateau. But in my opinion, that's because of our relationship with China. That China was so distortionary to the interest rates, the risk-free rate, and growth, that basically growth and interest rates decoupled in the developed world, particularly in the United States of America. And if you ran an economic model where the growth rate and the discount rate were decoupled, you could have very high corporate profits and you could have very high valuations. So you'll not be surprised to know I have an answer. The answer is that it all stems from this perverse global monetary system that we set up in '94, which was really beginning to bite in the early 2000s. And if that goes, the whole damn lot goes.
Well, then you must be incredibly bearish about profits in the stock market. Could we put up number 7?
Yeah, sure.
Used to be true. BCA, the company I worked for, that was its business, the bank credit analyst. We forecast everything based on money numbers, and it worked brilliantly until the 80s with financial deregulation, and the relationship between money growth and the economy and the markets evaporated. The Fed stopped talking about money, 15, 20 years ago. It doesn't even mention, doesn't target money, doesn't mention money. Quantitative easing, if you looked at the monetary base, you've never seen anything like the explosion in narrow money during quantitative easing. Did inflation go up? No, because the plumbing system was blocked. It was trapped in the banking system. Broad money never rose. The level of interest rates was the driver. And when I've looked at this thing, I found the best indicator of the stance of monetary policy is not the money numbers, it's the gap between the level of interest rates and nominal GDP. And inflation generally rises if the Fed keeps interest rates below the growth in the economy. Inflation will go up. And the money numbers are, monetary velocity is not stable. The numbers, you can't make any sense of them.
Okay, so once again, the reason that I'm not disputing the relationship clearly broke down from the 80s. And when I ran the course in New York, we got Henry Kaufman to come and talk about this, and Gordon Pepper as well, and both of them were the great sort of broad money guys of the early 1980s and had to stop. Why did they have to stop? I think there are 2 reasons: open capital markets, but the second one was the disintermediation of credit. So in the bank credit analyst era, when it was doing what it did very, very successfully, there was a relationship between the growth in bank credit and money. there is now no relationship between the growth in total credit and money. And what we've had in this disintermediated, this is getting quite technical, but in this disintermediated world, we had a huge growth in non-bank credit. So if you were trying to forecast things, actually money wasn't that important, I don't think, in that period, because you had to also be looking at the total amount of credit, which is the great mistake of central bankers in the run-up to 2007. Now, I think we're going for re-intermediation, which I didn't talk about here because it's hardly the most interesting and sexy subject in the world. But most going forward, I think we'll look at the re-intermediation of credit in this new world, and therefore there will be a much clearer link between aggregate credit and money, and therefore money will be much more important. And to show that it may have started, clearly we produced a lot of money and had a lot of inflation. We haven't produced any money really for about 2.5 years, and inflation's evaporating. But it is absolutely about the structure of the system. And if we get to capital controls in particular and the re-intermediation of credit assets, then this relationship with money will reassert itself. So one to discuss over a beer. But you know, we've lived, you've been doing it a bit longer than I have. We've lived through some massive structural changes. And some of these relationships broke down. But they come back if we go back to sort of the old system. And I think that's where we're going to. Yep.
Hi, thanks for the talk. Very interesting. I'm a layman, so this might be a bit of a stupid question. But a lot of what you talked about was really about the monetary system. And I was wondering whether crypto was going to be a game changer and were there any lessons from history about what we might expect from that?
Yeah, well, that's absolutely not a stupid question because this library has lots of examples of private sector currencies. So Scotland would be perhaps the best example of a private sector currency. We had, I think it was up until 1842, something called free banking. So I could walk out into Princes Street and I could say, I'm a bank, and I could issue my own banknotes. So you'd walk in to borrow £100 and I'd put the Bank of Napier on it. You'd walk out into the high street. The question was, would anybody take banknotes with the Bank of Napier on it? But as long as they had confidence in me and confidence in my balance sheet, they would, and that happened spectacularly, particularly in relationship to a thing called the Bank of Air. But that's private sector money. There were no regulations. You couldn't stop me opening a bank. You couldn't stop me creating money. I could create as much money as I wanted as long as the public were prepared to accept it. So private sector money, which is what that sort of crypto is not a new thing. It's happened before. Now, of course, it gradually went away, and it gradually went away because the government kind of made it go away, because the government didn't want it. They tried it in America. Andrew Jackson was very keen on it. It was called wildcat banking. But it led to great surges in the supply of money, great contractions in the supply of money, which even people in the 19th century who were used to that sort of thing didn't like. And if you look at that chart up there, you'll see the 19th century in America, and you'll see that black line is how often the US economy is actually below the line. And one of the reasons for that was monetary instability. So the government eventually comes in. Now, this is answering your question, but from a financial history perspective. If we do get a successful private sector currency, let's call it Bitcoin as the one that wins, the government has to do something about it. It cannot allow, if that is as fungible as the pound in my pocket or my debit card, the government could not conceivably cope with a massive change. Back to Martin's discussion we just had on the impact of the supply of money. They really couldn't leave that up to, let's call it an unregulated part of the economy. So it would at the very least have to be regulated. So that's the first reason I don't think ultimately we'll have them, because they would be too destabilizing if they were indeed fungible. And they're not that fungible at the minute, but if they did. So that's the first thing on Bitcoin. But there are two other digital currencies that probably will work. So the first one is a central bank digital currency, which will come from the central bank, and they are in action. I don't think they'll ever become too big because, without going into the details, they pose real threats to the stability of the commercial banking system and create real problems with the concentration of power in a central bank, but that we might be using some central bank digital currency. They have it in the Bahamas. I go to the Bahamas a bit. I was sitting beside a man at dinner, and I said that nobody I knew uses it at all because there's actually not a lot of pickup in utility over your debit card. I mean, how can you get more utility than a debit card? I mean, anyway, I said to this gentleman, do you use it? He said, I use it all the time, and he showed me the account and how he used it. And I said, well, that's really interesting. You're the only person I know who uses this. I said, what do you do for a living? He said, I'm the central bank governor of the Bahamas. So there was a lady sitting to my right, and I said, do you use it? She said, yeah, I use it all the time. I said, let me guess, you're the wife of the central bank governor. So I don't think the central bank, that'll be around, but I don't think it'll get so big. It's a threat to liberty. And that leaves the other form of digital currency, which is the stable coin. Now, I think there's a great future for the stable coin, and I think governments will love the stable coin. What a stable coin is all the technology of crypto, but behind it, there are high-quality assets. And the ultimate high-quality asset is short-term government debt. And why wouldn't the governments like that as a form of crypto? So in terms of you and I transacting and buying things, I can see a time when that might be a fungible currency that the government likes, because ultimately it's part of their funding model. But I can't see this issue with the private sector money being allowed. And then the next thing is, it's really a great big loophole that allows people to move money incognito. And if we're moving into the world that I've been talking about tonight, this is kind of the last time you'd expect the state to be saying to people, oh yeah, don't worry, there's a great big black hole and you can move money through that, and we can't track it down. The really interesting story on crypto, I think, is the one of the Chinese lady in London, which is written up in the Financial Times. She was working at a Chinese restaurant, but then she bought a house worth £2.5 million somewhere in London. And when they raided the house, they found a memory stick with $8.5 billion worth of crypto on it, which had all been, I better use the word allegedly for the sake of the charity, allegedly stolen from Chinese investors. But how did they catch her? Because eventually, because it wasn't really fungible, eventually some of it had to come into the real world. And when it came up in the real world, things started flashing. So crypto, I don't think it's what it's billed to be. It's certainly not a currency. I think its proponents even say it's not a currency anymore. I think if it's a great big loophole in the capital account, I don't think it'll be permitted. But I can see a central bank digital currency. I can see a stable currency. But they wouldn't be radically different from where we are today, unless the central bank digital currency becomes huge and we all have our deposits with the central bank and not the commercial bank. And then, frankly, whoever runs the commercial bank will be the most powerful person in the history of the world. More powerful than Stalin, Hitler, and Mao Zedong put together. And that is why I think it isn't going to happen. And it's not just me who thinks that. The man who runs the central bank union, which is called the Bank of International Settlement, is called August Carstens. And he's written a paper explaining why we can't let the CBDC get too big, but maybe it could be a relatively small thing. So I don't fear the Bitcoin as a citizen, but I absolutely fear the central bank digital currency in terms of the concentration of power in the hands of one man or one woman. Right at the back, Alistair, I think.
Yeah. Thank you very much, Russell. Very good as ever. I suppose this is potentially more for the pub at some point, but I mean, 21 seems to be, a good number, but I've got a few more that we can go into more detail.
Yep.
But one I would highlight, which I think is potentially relevant with the budget, etc., coming up, is the minute the government targets the wealth of an asset, the wealth in that asset generally disappears.
Okay. Definitely one for the pub. Any others you'd like to throw in?
I've got another one.
This isn't the party political broadcast.
Yeah. No. The minute the government targets an individual statistic number, be it, credit growth or M2 or whatever it might be, that number immediately gets bypassed by the system and becomes completely irrelevant.
That's Goodhart's law, isn't it? That's Goodhart's law. This is the great thing about financial history. Some of us in this room have lived through a lot of it and have learned a lot. And you might be surprised if you haven't got a formal education in finance. It's not on the syllabus. To me, quite a striking anomaly. And we don't have a lot of people from this world teaching in that world. And obviously we need more of them. And one way to smuggle them into the curriculum may be under the guise of history. So you've all learned a lot. Make sure you pass it on to the next generation. But if you want to turbocharge your understanding, then come to Library Mistakes. Read more financial history. David.
I think we've run out of can I ask 3 questions myself?
Okay.
First up, have we got an extremely interesting display from the librarian at the back?
Yes.
That has cuttings, I think, from the 10 years of the history of the library, just at the back. That is great. Secondly, have we got an amazing new podcast, I think, out that you might want to publicise? And thirdly, I think on October the 10th, could I ask, is there another great session in our 10-year celebration where you'll be interviewing someone interesting?
Yeah, we make a great team, don't we?
We do.
Yeah.
The event on the 10th will be?
Well, we have the exhibit. Please go and look at it. 10 years of Library Mistakes, from nothing to what it is today. The 10th of October, Charles Delara. Now, Charles is an incredible man. He was Assistant Secretary of the Treasury of the United States of America. ran the IIF, which is the sort of the trade body for the whole global banking system. But more importantly, restructured all of Greece's debt on behalf of the banks, which mainly involved negotiating not just with the government of Greece, but all of the European governments. So his book's full of stories about sitting in a room with Angela Merkel and whoever was the Prime Minister of France. It's hard to keep up. So that is an absolute must. His book is spectacular. There's nothing like it. No one's ever written the book and an insider in this sort of detail about how you go about doing that, saving, if you like, saving the cradle of civilization from destruction. I've done it again. What was the second question?
The podcast.
Oh, yeah, the podcast. So we've got a new one. This is the feistiest, most argumentative podcast we've ever had on banking from a lady who's not very keen on banks. So I think you'll enjoy that. I mean, really, because we don't want people on this podcast to agree with everything I say. So we've had a really good Barney on that one. So please tune into that podcast. Let me know what you think. You might well agree with it.
Nothing.
That's it. Drinks at the back. Thank you for coming, and thank you for 10 years of library.
Oh, yeah. Before you say it. Thank you very much.